The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.
Welcome to the Bucket Plan Podcast. Today's episode is going to be about bucket planning is not just bucketing. So what we mean by that is what you're going to learn about in this podcast. So who do I have here today? I have Jamie Hopkins and Dave Alison, two of the smartest people I know and some of the most intellectually stimulating conversations that I've had. And some of the conversations that I've had with both of you guys around this concept, I thought would be really interesting to actually have some of that dialogue together in this podcast. So welcome, guys.
Thank you for having us. Glad we stimulate you.
You are a stimulator.
I mean, I just felt bad when you said we're two of the smartest people you know. Need to get out and meet some more people, Jason.
So I wish you guys could see the screen because Jamie's got COVID hair. He's been growing his afro out, and he looks like a 70s NBA player. You need a jersey, dude, like an old jersey.
Yeah, I got to go work on my three, but it's a little tough to go play any games now, and it's something I should have bought. I don't have a basketball hoop here at the house, and I miss it. So.
All right, so let's talk about this. So what does this mean? Bucket planning is not just bucketing. So let's talk about the traditional definition of bucketing known throughout the bulk of the industry, I would say, which is what we call bridging. And we're going to touch on that a little bit more of how we teach in our bucket plan course, really as bridging as one of the options you can do for income planning within the middle bucket, the soon bucket. But Jamie, break it down for us a little bit, like just your experience at American College and just writing the billion articles that you write every month on all kinds of things. But let's talk about what the traditional definition of bucketing is.
Yeah, and I think that most people, when they hear bucketing, or at least the traditional one that probably Harold Ovinsky, made popular, was more of a bridging strategy, as you said. It was, historically he set 2 years of cash aside, and you had your short-term money, which was your short-term cash position, and then a long-term bucket after that. I think a little bit later, we got some more kind of steps on bucketing, and most people then became aware of a 3-bucket approach, and we kind of heard that. And that might have been more akin to time segmentation. So you got your, short, middle, and long, but didn't necessarily have any strategy on exactly how to fill up the buckets or, move money from one to the other or how to build it into a plan. It was really just kind of a very simple play on mental accounting. And, I think that's continued to grow over time. And so one of the challenges around bucketing, and I know this came from you and I talking, is that everyone does not have a similar view of it. That to some degree, bucket planning, as you like to refer to it, is different than just bucketing and sitting money into different mental accounting buckets.
Yep, no doubt. And so Dave, I'm going to kind of turn it over to you a little bit. Like, let's talk about bridging, right? What we call is bridging. And then the other two alternatives, if you are in fact in need of income out of your buckets, out of your soon bucket, the middle bucket.
Yeah, well, I think that clarification at the end is key because as we all know, most of the time when we're talking to advisors and they think of this concept of bucketing, they're thinking about income distribution planning, right? You're laddering bonds, you're laddering CDs, you're laddering annuities, you're essentially time segmenting. And when one segment or bucket is depleted, the next one then kicks on. So you're creating kind of this waterfall structure. And Jason, as you were alluding to there, we're going to talk about how bucketing and bucket planning in general can go beyond just income planning. But the bridge is exactly what it seems, what it sounds like, right? You're essentially structuring these time segments so that by the time you cross over this period of time, you're to the other side. And so, simple bridging concepts might be like, we have a 65-year-old retiring, and we want to simply buy a 5-year bridge to get them to age 70 when maybe Social Security is going to be higher and can be kicked on. And so essentially you're structuring, in that case, a 5-year bucket or time segment of money to get them from 65 to 70. Or maybe you're trying to build a time horizon to allow, capital markets to really do their thing and grow and not have to worry about short-term volatility. And so maybe in that case, you're buying a 10-year bridge of time period to allow that later money in that third time segment to grow without needing to really be accessed for any income distribution. And so I think that the bridge is probably the most common strategy when people traditionally think about bucketing. I think if you were to read any academic textbook, like ones that probably Jamie helped write for the RICP program at the American College, or I know in the CFP program, anytime they would refer to bucketing, it was really that time segmentation and setting up those bridges.
Yeah, and there can be multiple bridges inside of that middle bucket, the soon bucket. And that's a lot of what we do. It reminds me just of a case currently that I'm working on, getting ready to go to the delivery phase where we deliver the plan, the bucket plan to the client, and move the assets. But in that bridge, or in that soon bucket, first of all, we built a bridge for income for when they're going to retire, right? And that was more your traditional, like you referenced, Dave, like a 10-year bridge. And then what we also did, and we used an annuity for that piece of it. What we also did, though, is we built a Social Security bridge, because we did Social Security optimization. And originally they were going to take it at 66. Now it's going to be age 70. So there's a 4-year bridge of income to bridge to Social Security coming on. And then in their scenario too, they also have a healthcare bridge, because they have a younger spouse they're going to have to pay for health insurance for a few years before they go on Medicare. That's going to be a much higher expense than it will be when they go on Medicare. So we built all those bridges within that soon bucket, to ultimately, buy them that time horizon of that conservative, stable money they know they can rely on to let the rest of their money do what it does out in the later bucket.
Yeah, and I think one of the great points that you pointed out through those two versions is really the value of using, bucking as part of a retirement income plan too. This is also kind of similar language and issues that we run into, right? Is the, hey, look, here's retirement planning, but that's very broad, and we got the income planning, and a lot of things started to change. And then all of a sudden you're thinking about Social Security maximization, and how do you use that short-term to mid-term bucket to maximize Social Security, not the entire portfolio maximizing, but how can we get to there? How can we create bridges to get the best overall outcome in an income plan? And so I think that there's a lot of appeal. I think especially right now, as you're going through kind of a new type of financial crisis, the appeal to know where some of that money is coming from.
Well, and I think the other thing that the bridge, and Jason, we're going to talk about multiple strategies within the bucket plan, but I think that the bridging also is a pretty attractive option for a lot of advisors that maybe want to establish a bridge for the first phase of the client's lifetime. Let's say a client retires at 65 and the bridge gets them 10 years worth of income to get to age 75. And now when they are 75, we've had 10 more years of market growth. And when somebody is 75, we all know the annuitization rates on products like SPIAs and lifetime income products are much, much higher. And so you could then protect against kind of that tailwind or longevity risk at a time when the clients are much greater. And so I think a lot of people need to think like a chess game, not just what the plan is going to look like today, but the moves they might make in terms of like allowing that bridge to expire and now purchasing lifetime income when the client is a much higher age later on.
Yeah, which would be the flooring strategy. And I think that before we segment there, Dave, let's talk about for a moment reloading, building more bridges, right? If somebody doesn't want to transition into going into a flooring strategy later in life, because it is going to require more capital, but there's a lot of benefits to it, right? Hedging against longevity risk being the main one. But let's say you want to just continue doing bridging, because we find a lot of AUM focused advisors that are primarily, managing a book of AUM, and they want to utilize the least amount of capital as possible to solve the problem in order to build a CD letter, a bond letter, an annuity, whatever that bridge is made up of. They want to use the least amount of capital to allow the rest of it to grow in the later bucket. So if they were going to continue doing bridging, they're going to have to reload the soon bucket. They're going to have to build another bridge, right? And when is the best time to start looking to reload the soon bucket and build another bridge? And so let's talk about that first, Dave, on utilizing, capital to reload. And then I want Jamie to talk a little bit about alternative options like a HECM as well.
Yeah, definitely. So we've done a lot of research on the right times to reload, and clearly you don't want to allow the bridge to run out, right? And so you don't want to be to the other side of the bridge and then be like, oh no, we need to build another bridge, because what could happen at that time? We could be in a market environment like we are right now, where, maybe 6 months ago, you were going to let your bridge run out, and now March hits and the market is down 30 or 40%, and it's not an opportune time to go sell your later bucket to go buy a new bridge in your soon bucket. And so what we've really seen is a best practice rule of thumb, and a lot of the research to eliminate that type of risk is when you are 5 years out from depleting your bridge. So let's say you're taking $30,000 of income out to supplement Social Security and pensions. That's your annual income gap. Well, when you're 5 years out, or you have $150,000 or less, it's time to reload. And so what you essentially do is you look at the market. And if the market is up like it had been historically leading up to February 19th or so, whenever we peaked out, then you would clearly reload. Like Jason, if you had been doing an annual review with a client in January of this year, and they had 5 years or less of income, it would have been a good time to reload their soon bucket, or in essence, buy another 10-year bridge. And what they would have had is they would have had 5 years of income in their soon bucket. You would have had to buy essentially another 5 years to get them to a total of 10. So you would have taken some gains from the later bucket, bought another bridge in the soon bucket. Well, flip the scenario, and today you're doing a virtual meeting with the client, doing your annual review, and they only have 5 years of income left in that soon bucket. Are you reloading? Well, no, you're not going to reload now. I mean, there's so much uncertainty in this market, but I think most people agree that 5 years from now, 6 years from now, we're going to have recovered, at least recovered from the lows that we're at today. And so you'd wait a year, and next year, now they have 4 years in their soon bucket. Maybe the market's rebounded, maybe it hasn't. Maybe you wait another year, 3 years, the market's come back, or it hasn't. 2 years, the market's come back. 1 year, no years. And then, of course, they probably have an emergency fund. So the reality of it is, if you set a process in your business that you're 5 years from depletion, automatically in your CRM triggers in your annual review to reload, you probably have about 6 years of runway if we're in a big market downturn like we are today or like we saw in 08, 09. And so that's one kind of fundamental way to reload so that you don't get caught in a big down market with nothing left in your soon bucket.
And Dave, just from a historical perspective, 2000, 2001, how long did it take to go from the all-time high down to the very bottom, all the way back to the all-time high? Peak, trough, peak.
Yeah. I mean, every time we've had a historical kind of black swan market event, it's typically been about 4 to 5 years. I mean, the dot-com bubble was 4 to 5 years. I think dot-com was about 5 years. 2008, 9, the financial crisis was about 4 years or so. And so, I mean, those are worst case scenarios. As you know, we see a lot of 20% plus market corrections. I think we've probably seen a dozen of them over the last 30 years or so. Those are the big ones, though, that we've seen at least since the 80s. And even in those situations, it's been about 4 to 5 years.
Right. And then, Jamie, there's an alternative, right?
Yeah. I mean, I think part of what you're getting to here is the mechanism in which you create bridges or income during buckets, right? To some degree, the right way to do it is to be agnostic on it, right? It's just what assets do we have that can create that cash flow? And I mean, that's really when we get to retirement, it becomes much more about, as I always say, cash flow, cash flow, cash flow. I mean, that's really what it's about. If you can generate the cash flow to do the things you want to do and sleep well at night, you're well off. If that's all locked up for other purposes, maybe don't feel that well off. And so, you know, things like whether you're looking at reverse mortgages, right, home equity conversion mortgages, and setting up lines of credit or setting up, you know, you can create bridging strategies with that. It's something that Wade Fowl and I did some analysis on deferring Social Security. Now, it's not necessarily the optimal strategy, but compared to nothing, you can show that using reverse mortgage term payment for 5, 6, 7, 8 years and then repaying it back can actually still work out even with Social Security. Now, again, not optimal because you're taking on debt, but you know, it is something that can come into play. And that goes across the board, whether you're downsizing and freeing up equity in their house, whether you're using a regular line of credit, you know, which have some challenges though in downturns, right? Like that tends to be, I'd say, you know, when I went through CFP and things like that, I feel like that was what they would tell you to do is set up these lines of credit. But now we're kind of going into possibly our second major, you know, financial crisis over the last 10 years. And, you know, the 08, 09, 2010, problem with the regular HELOCs is that most of the banks froze or pooled them. You very well could see right now with interest rates as low as they are, with a bunch of other free capital, that banks pull away from those at some point during this crisis too, especially if housing prices dip. I mean, that's the next key piece is they have very little wiggle room on rates right now. Liquidity is being provided elsewhere, so why should banks get into borrowing on those? And you very well could see that occur again. And so then that starts to question, right, this whole argument about where do HELOCs actually fit in because they're still tied to your house value. There's a lot of risk that the banks can pool them. So to some degree, relying on that too heavily as your safe bridge, I think that there's some question marks surrounding that today. Different than a reverse mortgage line of credit, which isn't going to get pooled, doesn't move as your housing price moves. So just kind of when you're thinking about, is this really a safe bridge in my near-term money? I think that it comes into part of the conversation. And when I talk to advisors, when I compare those two, that's always been kind of an eye-opener when people are like, oh yeah, I remember 08 and 09 and all those lines of credit being frozen and pooled, and we were going to rely on them during the downtimes, right? And then it was gone and you didn't have it. So, and it to some degree, it was kind of understanding the product and how things would change over time. But we have a little bit of better understanding of that now. And I think people that still rely on that could get caught in that time period again here. But yeah, just, you know, keep the products open. And I think that's something we wanted to talk to about too, just, you know, being agnostic when you're thinking about, you know, products falling into a bucketing plan.
And I think that's, I mean, that's the way I've looked at the HELOC though, is what it gives you the ability to do. I wouldn't use it like as my bridge, but what I would use it as a backup if my bridge, this allows me to let my bridge run out if I wanted to, or to keep a shorter bridge, right? So I don't have to keep reloading back to a 10-year bridge. I could maybe manage it always to be more like a 5-year bridge that runs to 0, that goes to 5-year reloads, so it just gives me the opportunity to potentially, utilize a little bit less in the soon bucket to maximize the amount in the primarily equities in the later bucket.
Yeah, and I think you can do a lot of things to shorten down, whether it's, a HELOC or reverse mortgage line of credit, does give you some of that backup flexibility, right, in case your bridge starts to decrease and markets kind of plummet at the same time. I mean, now's a really, as you guys said, now's a great example of that. If your bridge was running out and all of a sudden it's now, and the markets went from 29 down to 18 one day, right, and in the Dow, and then you're sitting there thinking, well, I'm not going to replenish right now, so where else could I pull from? Then all of a sudden your home equity becomes that backup that you can use, especially during volatile time periods, so you're not having to sell out of markets that, especially what feels like a bottom or a declining market.
Right. No doubt.
Did Jamie just call the bottom?
So I did get in trouble for calling the bottom recently. Yeah, I don't know where the bottom is going to be, right? You can't predict that. It's a really cool thing if you look at if you miss the top 10 best days over the last decade, right? You go from like that 8% return down to a 4% return. Because a lot of people think that you have more average days, but you really never have, 0.02%? Is that the right thing? Something right around there, right? If you took 8%, divided it by the 300 days or whatever, right? You get it like 0.02 something a day, but you almost never have that day, right? Like it's always more or less. You never really get what an average day should be. So you can't kind of buy back in as an average. So that's why I always like timing the bottom so hard, because you tend to get these really fast jumps back up. And if you miss 3 or 4 of those, all of a sudden your return's been shot.
Yeah, that's like the average weather in Cleveland, Ohio.
Yeah. Is that the one that's the same as San Diego? Somebody told me this, that it's somewhere in the middle of the country. I think maybe it's St. Louis has the same average temperature as San Diego.
Really? It's definitely not Cleveland.
No.
Yeah,
Maybe
you guys
St. Louis. They get some hot days that average into there. Yeah.
Yeah.
So that makes sense. Right. So we talked about like kind of the, the 3 different, or I referenced before that there's 3 different ways that we create income out of the soon bucket. The traditional definition of bucketing is bridging, right? Of what we call bridging. But then there's flooring, right? And so flooring, made pretty popular by Tom Hegna, right? I believe is who kind of came out with that flooring terminology, as far as I know, at least, or made it popular. That's the other approach. So that one's pretty easy. I mean, that's just really buying lifetime income annuities, right? Similar to a Social Security or a pension check. You're giving money to an insurance company to guarantee you a paycheck for the rest of your life. Doesn't matter what chassis you're doing it on, a fixed or a variable. At the end of the day, you're just giving the insurance company money to give you a check for the rest of your life, right?
Yeah. One of the things that we always taught in RICP too on income planning is that almost every plan has some type of floor, right? And then flooring really becomes more of a conversation on how much of a floor do you want, right? Because almost everyone is either going to have a pension or Social Security in the United States, right? That's going to get you pretty much to about 99% of the population
Right.
that's in the workforce. So somebody's going to have some type of floor. And, probably what, academics took it a step further eventually, and Tom actually falls more into this mode of flooring too, which is essential versus discretionary, right? Which is, what do you need as income so it can free up your other assets to do the things that you want to do, and that's this paychecks and play checks. So that's more this say, hey, here's all the things that I need every day, I can't get by without them. So I should make sure that I have income that's safe, that supports that, so I floor my essential mandatory expenses, and then I can pull my discretionary from other sources of income. And so, whether you call it flooring or essential versus discretionary, is often other names too, but those would probably be the two most common that I hear on that side now.
Yeah, and sometimes we'll do a combination of the two, right? I mean, we'll do bridging and flooring in the same plan, right? In the soon bucket, you get somebody who is a little older, like you gave the example before, Dave. Maybe we built a bridge for income the first time for 10 years. Now they're 75. Now we're switching over to flooring for their baseline income, but maybe we also need to create a bridge for some type of for Roth conversion planning. In some cases, we'll use non-qualified money to be able to create part of that income to be able to do 4 years of Roth conversions on a set amount of money and spread that tax liability. So that kind of that opportunity is there of mixing, bridging and flooring. Then the third. So what's the third, Dave?
The third is just, your traditional kind of portfolio yield. And so, there's many people get to a point that generally they're higher net worth clients, but they might be able to live off of just dividends and interest. And so, they've got a portfolio of assets that is, let's say they're invested in traditional S&P 500 index that's kicking off 2% dividends, or they're in a portfolio between fixed income and equities, and it's kicking off 2 to 3%, or maybe you're in a more targeted dividend portfolio strategy that's kicking off, 4% dividends before all these companies, of course, start cutting dividends. We know in these cases, it's non-guaranteed, so you don't have necessarily the same level of reliability from it, but it certainly does eliminate sequence of returns risk, because in that case, you're not selling into principal, you're simply living off of the dividends and interest. And so, for example, if a client had a $40,000 income gap, and we could construct a portfolio of dividend paying stocks or fixed income, or even, REITs, whatever vehicle we're using to produce yield, and that yield was 4% per se, we could fund $1 million in that soon bucket. Of course, $1 million at a 4% yield is kicking out 40 grand a year of income to them. And so that's another way to ultimately construct an income stream out of the soon bucket that's going to flow to their now bucket for them to live off of each and every year, still eliminating the potential for sequence of returns risk. But as you can see, and as you know, Jason, you need a lot of capital to make that happen. If you're using a bridging strategy, for example, like we spoke about earlier, to create 40 grand of income for 10 years, I mean, even if you put it in your checking account earning no interest, you need 400 grand to get 10 years worth of income. And that's, a much different number than if you were living off a 4% yield. You have to hold $1 million hostage to generate that yield. And so something I know Curtis Cloak has spoke about this a lot. He's probably the first person that, really pounded this concept into my head, but it's how much discretionary assets does the client have at that point? Because if the client's only got 1.2 million and you need $1 million to put in a dividend portfolio to give them 40 grand a year of income, all million is hostage. They only have 200,000 of discretionary assets that they might be able to use for other things in their life. And so that's why we typically see that strategy work for high net worth individuals. But the majority of Americans retiring these days, they need to tap into both principal and interest. They can't just live on dividends and interest.
Yeah, and I actually love that Curtis did a really good job with that whole concept of kind of true liquidity, right? And, really, if you're saying, hey, I've got to fit this investment portfolio to fund this long-term goal, then that's really not true liquidity, because if that's true and I can use that at a different time, then I'm not funding that long-term goal. And, Wade Fowle's done some research where, he's actually done modeling now, and he's used that concept of true liquidity. And one of the things, right, that he sees is when you floor, right, you do increase your true spending power over, right, total investable strategies, because you do put a lot of your assets hostage, quote unquote, right, to those long-term investments. And, right, if you're going to pull those assets out in a 10-year period, you've got to drop down what your assumption on return would be, because you're going to run into more volatility and, sequence of returns risk issues like that.
That's great. Yeah. So just to kind of recap, when we're looking at income out of the soon bucket, you have bridging, which is the typical definition of bucketing across the industry. But in bucket planning, which is the time segmentation based on the purpose and the time horizon of people's assets, it's really time segmenting their money and based on the purpose and time horizon of the assets. In the soon bucket, you can do bridging, right, which is traditionally also known as bucketing. You can do flooring out of that soon bucket, or you can do portfolio yield. Portfolio yield is going to require the most amount of capital. Bridging is going to require the least amount of capital. Flooring is going to come somewhere in the middle of the two. But they're all three great income options out of the soon bucket. It's based on advisor discretion, but most importantly, knowing your client and what resources they've accumulated. A lot of people are automatically disqualified from a yield. They don't even have enough money to do that. So then you really just have bridge or floor. Well, then you also run into a lot of people who don't have enough money to really do flooring. It's just going to monopolize way too much of their assets. And now they have very little in growth assets out in the later bucket. So the bridging's really the only option. So it's knowing your client. It's the advisor preference plays into it as well. And what assets that client is ultimately accumulated. But, the 3-bucket approach of bucket planning, now, soon, and later, the thing is sometimes income's not needed. Sometimes that person between pension or Social Security or whatever it is, they don't need income out of their assets. So sometimes, though, they still have a certain amount of money that they want invested more conservatively, which is typically that soon bucket. Now bucket safe and liquid. Soon bucket's your conservative money that you could take income or withdrawals if and when you need it. And sometimes it's an opportunity bucket as well, right? Like right now, I have a lot of my clients that had a hefty soon bucket they didn't need to take income from now, and they're repositioning a portion of that soon bucket because it's an opportunity bucket into the later bucket to buy into the equities when it's down 30%. And so then the third bucket is your primarily equity long-term growth money. But so just to be clear, it isn't all about income bucket planning. It's about time segmenting the money based on the purpose and the time horizon. If you are doing income planning, bridging, flooring, or portfolio yield, they're all great out of the soon bucket. But it doesn't mean your clients shouldn't have a soon bucket just because they don't need income.
Yeah, and Jason,
Definitely.
I think this is something that it's sometimes a little bit hard to grasp too from the bucketing. And I know you and I have talked about, what do you do with some of these? Well, depending on what your goal is, you might allocate things a little bit differently too. And we talked about the home, the one time, and where do you put that? Do you include it in bucketing? If you're not actively using it as part of a strategy, do you just sit it in the third bucket to show that this is some of their wealth? And if they're planning on letting the house sit till they die and leaving it as a legacy, it's a legacy asset. And it's, a slow growth, keep up with inflation one, but it's part of that third bucket because that's when it's being used. And I think that helps some advisors just engage in more holistic planning because they're then able to talk about these different assets and the purpose of them in an overall plan.
Yeah, I think that the power of the bucket plan, I mean, there's so much kind of science behind it. And, there's all these academics that are creating studies, a lot of different programs that you can kind of read a lot of the theoretical research. But I think that the biggest value is how powerful of a communication tool it is. I mean, the philosophy of bucket planning, right? The bucket plan can be used to communicate all the valuable financial planning. So it's an asset allocation philosophy the clients can actually understand. I was talking to a client at one point, and he actually, younger client, engineer at Apple, and he was actually setting up different accounts for all these different purposes. And essentially, he was like bucket planning some of his own money, right? He had these different accounts, but they were essentially buckets. And so clients, they can actually understand that. And that's why I love the philosophy of kind of this open architecture approach to bucket planning, is the ability to communicate these more complicated or advanced strategies to clients, because they can simplify and understand having a now bucket, the money that you need sooner rather than later, for your goals that you have in the next 1 to 2 years, having a soon bucket for your goals that you might have between years 2 and 10, having a later bucket for your longer term goals. It just helps package all of this together nicely.
Yeah, I mean, what you said earlier before we got on the podcast, Dave, like Walter Young, one of the advisors that you did another podcast with, that works with us, is how he said what he loves about the way we do bucket planning is it's an open architecture. And so it allows the advisor to have their own opinion and pick the tools and strategies, whether they do a lot of cash value life insurance or SPIAs or DIAs, or maybe they believe in flooring and do a lot of lifetime income annuities. Maybe they don't believe in annuities at all and they build CD or bond ladders, or maybe they're all AUM and they're just building conservative portfolios in the soon bucket and more aggressive or growth portfolios in the later. It just gives all that flexibility.
Absolutely.
All right. Well, I think we kicked this topic around pretty well today, fellas. I appreciate the conversation. This is fun.
Yeah, and I think, there was, one more thing I actually wanted to kind of touch on before we go, which is, as I moved from academics into a firm at Carson Group and trying to see, what often people hear bucketing, oh, that's very simple. You've got 3 buckets, you put assets in it, you generate income, nice and easy. And, I think that a lot of people underestimate, as we've kind of talked about, the complexity, the academic kind of behind it, how to refill buckets, how to talk about it, the processes you need. And, it is actually a very complex thing that's, making that complex simple when you actually have to instill something like this to advisors into your practice, into a firm. So kind of making sure that you do have the right training and processes and things that you guys have built out is very important.
Yeah, I appreciate that. And it's sophisticated, right? And as Leonardo da Vinci famous quote, right? Simplicity is the ultimate sophistication. And so that's what you got to do. You got to keep it simple. All right. Well, thanks, guys. And thank you, everyone, for joining us. And we'll be catching you soon on the next podcast.
The Bucket Plan On Demand series is brought to you by Clarity to Prosperity, a financial training, coaching, and IP development organization led by financial advisors, coaches, and business leaders committed to taking a holistic approach on advising. To learn more about our organization and upcoming training opportunities for financial professionals, visit claritytoprosperity.com.